Good morning, you're watching The Mint, I'm Andy Hodges. In our main story this morning, we look at the Zimbabwe dollar exchange rate. If you changed US dollars in Zimbabwe in 2019, you would have received a rate of $1 US to 2.5 Zimbabwe dollars on the official market and around 6 to 1 US dollar on the parallel market. That's in February 2019. Fast forward to today, the 6th of March 2020. If you change your US dollars today, you would get an official rate at the bank of $1 US to 18 Zimbabwe dollars. And if you changed on the street, you would get a parallel market rate of around 32 to 1 US dollar. The recent move to 32 to 1 US dollar has occurred only over the last week, moving in that time from a parallel market rate of 25 to 1 US dollar. The Mint decided to ask one of Zimbabwe's top economists, Brains Muchemwa, why has the official rate remained stable and why is the parallel market rate moving?
The exchange rate has remained largely stuck at around 1:17 to the US dollar, itself a reflection of the desire by the policymakers to try and influence the pricing levels in this country. However, the reality on the ground is that the exchange rate has not been as stable. In fact, the parallel exchange rate has since moved northwards of 30, itself a reflection of quite a number of issues. The first issue is largely the demand for foreign currency that is emanating from the need to import huge stocks of maize and mealie meal to ward off a humanitarian crisis, considering the huge shortages that exist on the domestic market. In fact, the huge queues for mealie meal reflect the huge shortages that exist in the economy, and the situation can only be assisted by importing maize and mealie meal, and that on its own requires foreign currency, and as such there's been a huge demand for foreign exchange to augment the thin domestic supplies of mealie meal and maize. On the other hand, the exchange rate has well been depreciating as a result of the increases in the domestic money supply. You would be aware that the exchange rate reflects the balance between foreign currency and domestic currency that exists in this economy. And when you look at the money supply that has been increasing on account of subsidies that are going into fuel, that are going into maize, mealie meal, etc., all those subsidies, they result in a huge and unproductive injection of money supply into this economy, and that is combined with the demand for foreign currency to import maize resulted in the huge increase or depreciation of the exchange rate.
In Zimbabwe, what rate you change your foreign currency at is only one of the issues that citizens must be concerned about. Another major issue is the impact of the movement in the parallel market rate on prices of goods and services in the country. You see, it has now become common practice for businesses in Zimbabwe to price their products based on this parallel market rate. And in fact, the Mint, speaking to sources at retailers, was told that businesses in fact using a rate closer to 45 to 1 US dollar when pricing their goods. Brains Muchemwa speaks to this.
Pricing of goods in this economy has now been benchmarked to US dollars, and as such we've been seeing some increases in the prices, in the general price of goods and services, because most of the producers and businesses in this economy are now working on a replacement cost model that tracks the exchange rate, and that unfortunately has resulted in an unending increases in prices of basic goods. And
Zimbabweans are facing a catch-22 situation. If the parallel market rate continues to slide further, Zimbabweans can expect steep increases in the prices of basic commodities. If the Zimbabwean authorities do not manage to control money supply, inflation will rise, leading to an exchange rate depreciation and once again a sharp increase in prices of goods and services. Something has to give. Control over Zimbabwe's economic fate must be bold, strong and firm. Otherwise, the only people who suffer are us Zimbabweans. In news received yesterday, the Zimbabwe Energy Regulatory Authority has once again increased the price of fuel in Zimbabwe. In fact, a litre of diesel is now going for $17.28 per litre, $18.66 per litre, and a litre of petrol is now going for $18.70 a litre. That's up on diesel from 17.28 a litre up to the 18.66. And in fact, prior to the 17.28 per litre, it was at 19.55 cents per litre. So that's an increase quite substantially. And of course, blend used to be $18.40. That was only changed on the 28th of February, which was last week, Friday, and it's now trading at $18.70 per litre. For those seeking to help the worst off in poor countries, the mobile phone has been a magic wand. Mobile money accounts have helped deliver financial inclusion, making financial services accessible to the tens of millions with a phone but with no bank account. But they have downsides too. The most obvious way digital financial services harm poor people is by laying them more open to fraud. Research from 2016 cited in a new report by the Consultative Group to Assist the Poor, CGAP, a consortium of donors affiliated to the World Bank, found that in the Philippines, 83% of people surveyed had been targets of mobile money scams, with 17% losing money. In Tanzania, 27% had been targeted and 17% fleeced of their money. In Ghana, 56% and 12%. For the most basic deceptions, a thief needs only a phone number. A text message might offer congratulations on winning a prize, requiring only a small contribution to unlock it. Your identity might be stolen to make you responsible for repaying a loan dispersed to somebody else. An impersonator might steal your mobile money account when registering a new SIM card. Or your account security code, the PIN, might be leaked by a mobile money agent, one of the millions of small traders whose business includes turning mobile money into hard cash. The poor may be especially susceptible to such scams. They are more likely to be relatively new both to the online world and to formal financial services, and they are less likely to have smartphones with sophisticated security software. It is not just money that can be stolen too, so too can the other data stored on a phone. Often, however, much has already been given away freely by its owners. Many free apps are in fact paid for in customer data. In every country, people daily sign away their rights to privacy by clicking consent buttons without having understood or even read what they are agreeing to. Indeed, in financial services, the implicit sale of personal data is seen as a way in which the poor can be leveled up. With low unreliable incomes and a few assets, they have been unable to borrow formally. Now lenders are learning to rely on other data to make credit judgments, notably payment records, such as from a mobile money account, which can show a history of reliability. But such data can also be abused. Predatory lenders and vendors might learn a costly loan or product would be hard to refuse, or an algorithm might, by design or accident, be biased against certain borrowers because, say, of their race or creed. It is often assumed that the poor are relaxed about surrendering some privacy in return for access to borrowing and other services. In fact, concern about privacy is not the preserve of the rich alone. Research in India and Kenya has shown that even very poor borrowers would be willing to pay a higher interest rate or join a much slower queue for a loan that came with more guarantees that the data provided to the lender would be kept private. Persuading the tech giants that improved data security for the poor is in their business interests might be the best hope. But that will take a lot more work. In the absence of a vaccine to halt the spread of the novel coronavirus, it is not surprising that governments, notably China, have attempted to contain its spread by restricting the movement of its citizens. But this has come at a huge cost, as Chinese data out last week has shown its economy has been dealt a body blow, the official manufacturing purchasing managers index for February tumbling to just 35.7 points, the lowest on record and well beneath the 45 expected. China drives global growth. Hitting the brakes is bad for the world economy. The United States' busiest port, the Port of Los Angeles, said last week it was projecting a volume drop of at least 25% in March due to the coronavirus, a drop of 1 in 4 goods imported from Asia. In the meantime, the virus has spread to 50 other major countries and was showing signs of traction in 3 of them, Italy, Iran and South Korea, suggesting while it did appear that movement controls had slowed its spread in China, the virus appears to be on its way to becoming a global pandemic. Major markets hit the skids, with the FTSE 100 down 13% on the week, its worst one-week fall since the 2008 financial meltdown, and the Johannesburg Stock Exchange losing 11% of its value during the same period. More than $1.1 trillion was wiped off the value of developing nation stocks and bonds last week, as the economic impact of the coronavirus worsened, Bloomberg reported on Monday. On Tuesday, the US Federal Reserve slashed American interest rates by half a point to a range of 1 to 1.25%, with the Federal Open Market Committee saying coronavirus poses evolving risks to economic activity. On Friday, before the rate cut, Federal Reserve Chair Jay Powell sought to reassure businesses and investors, saying the fundamentals of the United States economy remain strong, but promising to use our tools and act as appropriate to support the economy through the coronavirus hit. Similar statements from the central banks of England and Japan led investors to believe that a coordinated response was likely. Also on Monday this week, the Organization for Economic Cooperation and Development, OECD, said that, and I quote, "Even in the best case scenario of limited outbreaks in countries outside China, a sharp slowdown in world growth is expected in the first half of 2020 as supply chains and commodities are hit, tourism drops, and confidence falters." Global economic growth is seen falling to 2.4% for the whole year, compared to an already weak 2.9% in 2019. Broader contagion could cut global growth to as low as 1.5% this year, halving the OECD's previous 2020 projection from last November. Just how effective central banks' actions will prove to be remains to be seen. Analysts have cautioned for some time now that the relatively low interest rates mean central banks have little ammunition available for the job at hand. Central banks in emerging economies typically do not have the tools of their low to no inflation peers, but low interest rates in developed markets have in the past seen investors put money in developing markets in search of higher yields. Business Insider reports that handshakes transfer double the amount of bacteria that you'll get from a high five greeting, but fist bumps have the lowest risks of transmission. Health experts have recommended avoiding shaking people's hands in order to avoid the risk of being infected with the coronavirus, which was declared an international public health emergency by the World Health Organization, WHO, in January 2020. A study in the American Journal of Infection Control shows that greeting someone with a handshake increases the risk of viral transfer significantly. An early experience suggests the same is true of the coronavirus, first recorded in Wuhan, China. Transmission risk increases with greater surface area contact. Other variables include contact time and grip strength, both of which increase the risk of transmission. A different study found an up to 4-fold reduction in bacterial transfer through fist bumps compared to handshakes. Bacterial transmission can be reduced by up to 50% through high fives and up to 90% through fist bumps, and some even suggest banning the handshake entirely in clinical settings. If the greeting is unavoidable, an alternative could be to carry a sanitizer with a high alcohol content, which can have a bacterial effect of up to 95%. Although this does not mitigate the risk of transmission, it is a quick option to get rid of any bacteria that might have transferred during the handshake already. You've been watching The Mint. I'm Andy Hodges. Please follow us on our Facebook page, Zim Papers TV Network, our website, ztn.co.zw, and on YouTube under ZTN. Your comments are welcome via our Twitter handle at ZTN News and also via Facebook. Join us here on The Mint every weekday morning at 6 a.m. Central African Time. Well, that's it for me this morning. Goodbye, have a profitable business day, and you all be safe.